Hi everyone, stop right now. If you own SCHD and haven't checked this one, account setting, you're bleeding $107,000 over 20 years. I'll prove it with math in 60 seconds, but that's just mistake number one. The questions flooding my comments reveal the exact strategies wealthy dividend investors use that everyone else misses. Auto-reinvesting versus manual timing, combining SCHD with growth funds, tax optimization strategies, age-based allocation formulas. These aren't just questions. They're the blueprint separating financial freedom from mediocrity. With markets at all-time highs and concentration risk at 50-year peaks, getting these answers right determines your entire financial future. I'm revealing 5 strategies that separate wealthy investors from everyone else. The auto-reinvest decision that changes everything. Should you auto-reinvest dividends or manually time purchases during market dips? Here's the brutal truth. $10,000 plus $100 monthly contributions with dividend reinvestment generates approximately $240,000 in 20 years. Without reinvestment, only $132,000. That's $107,621 difference. From clicking one button. Manual reinvestment could theoretically add another 0.5 to 1% annually if executed perfectly. Over 20 years, that compounds to meaningful money. But here's what nobody tells you. 95% of investors who disable auto-reinvest end up with dividends sitting in cash, perpetually waiting for the perfect entry that never arrives. They miss 5% gains, then 8%, and suddenly SCHD jumps 15%, and capital never deploys. SCHD's dividend has grown at an average annual rate exceeding 11% during the past decade. Every quarter sitting in cash instead of shares means missing that compounding machine working for you. If you're genuinely disciplined with the system, like deploying within 7 days when price drops 3% or more, manual reinvestment works. Most people drastically overestimate their discipline. Their data is clear. Auto-reinvest wins for most investors. Manual timing wins for disciplined minority who execute without emotion. The combination strategy that actually works. How do you combine SCHD with growth strategies like VIG, VTI, or SCHG? Your age determines everything. Under 40 years old, deploy 50% into growth vehicles like VGT or SCHG, 30% SCHD, 20% bonds or treasury bills. You're capturing technology appreciation while building income foundation early. Growth provides upside exposure. SCHD delivers ballast and quarterly distributions. Bonds create dry powder for corrections. Between 50 and 55, transition to 60% SCHD, 20% growth, 20% bonds or treasury equivalents. You're capturing remaining upside while protecting accumulated capital. Income generation starts mattering more than pure appreciation. Over 55 years old, 70% SCHD, 10% growth, 20% bonds plus cash reserves. Prioritize reliable income over unnecessary risk. Shift from accumulation into preservation. Alternative approach, regardless of age, combine SCHD with VIG for pure dividend growth focus. SCHD delivers current yield of 3.77% plus value exposure. VIG provides lower current yield, but companies with 10-plus year dividend growth streaks. Together, you capture both current income and future income growth. Another sophisticated strategy, 30% SCHD, 40% VTI, 20% international developed markets like SCHF, 10% flexibility bucket. This creates diversification across value growth, domestic markets, and international exposure without overweight concentration anywhere. The tax secret nobody discusses. Should you hold SCHD in taxable accounts? Tax consequences matter tremendously. SCHD dividends qualify for preferential tax treatment, taxed at 0, 15, or 20% maximum depending on income brackets, not ordinary rates reaching 22 to 37%. Think about this carefully. High earners pay 37% on bond interest. Same person pays 20% maximum on SCHD distributions. That 17-point difference compounds into massive wealth over decades. Best sequence for optimization: maximize Roth IRA allocations to SCHD first, tax-free compounding permanently, then overflow into taxable accounts after exhausting retirement contribution limits. Taxable accounts trigger quarterly dividend taxes, but qualified dividend treatment at 15 to 20% beats virtually every alternative income source. Plus, SCHD's 0.06% expense ratio costs merely $6 over annually per $10,000 invested. Minimal portfolio turnover generates fewer taxable events. For bonds or dry powder, use SGOV or TBIL in taxable accounts instead of traditional bond funds. These Treasury bill ETFs currently yield around 4.5 to 5% with virtually zero interest rate risk. Traditional bond funds lose value when rates rise. SGOV and TBIL don't have that problem. The sophisticated sequence: SCHD and Roth first, then taxable. SGOV or TBIL for cash reserves. Traditional bonds only if betting on significant rate drops. If you're under 40 holding 100% SCHD, you're leaving growth on the table. If you're holding bonds and taxable instead of Treasury bill ETFs, you're paying unnecessary taxes. This isn't opinion, this is mathematics. The time horizon rule that saves fortunes. What's the minimum time horizon for SCHD? If your time frame is under 5 years, you have no business holding SCHD, period. SCHD can drop 20 to 30% in corrections, just like any equity fund. The dividend strategy needs time to work. Compounding effect, mechanical rebalancing, dividend growth all require 10 plus years minimum to truly compound. Need money within 5 years? Keep it in high-yield savings, CDs, or Treasury bill ETFs like SGOV. Don't subject near-term capital to equity volatility. SCHD's 10-year compound annual growth rate sits at approximately 12%. The 13-plus year track record since inception shows similar results. These returns survived the COVID crash, multiple bear markets, every correction since inception. Time horizon determines success. Under 5 years equal excessive risk. 10-plus years equal wealth compounding machine. The diversification advantage nobody sees. What about concentration risk in SCHD? Unlike the S&P 500, where 7 stocks now control 35% of the entire index, SCHD's top 10 holdings represent only 42%. Real diversification. Current top positions: Amgen at 4.8%, AbbVie at 4.5%, Cisco at 4.4%, Merck at 4.4%, Coca-Cola at 4.2%. No single company dominates returns. This matters tremendously during tech crashes. While concentrated investors watch portfolios crater, SCHD holders maintain stability. Healthcare, consumer goods, industrials, energy, balanced exposure across sectors generating profits today, not promises years out. Annual rebalancing prevents any position from becoming too large. When fundamentals weaken, dividend growth slows, or valuation suffers. Holdings rotate out automatically. No emotional attachment, pure systematic quality control. The market setup that changes everything. Here's where all strategies converge into one massive opportunity. Markets just delivered back-to-back years exceeding 20% returns. This has only happened a handful of times since 1871. Market concentration sits at all-time peaks. The top 8 companies control 36% of the S&P 500, not spread across 500 companies. 8 stocks control more than 1/3. SCHD trades at 16 times earnings. S&P 500 trades at 27 to 29 times earnings. Almost half the valuation for quality dividend growers, paying you 3.77% quarterly. When rotation occurs, and history guarantees it will, where should capital be positioned? Collecting dividends with intact cash flow, or watching wealth destruction chasing unsustainable valuations? Calculate your strategy based on age now. Under 40, 50% growth, 30% SCHD, 20% dry powder. Over 55, 70% SCHD, 10% growth, 20% reserves. Turn on automatic dividend reinvestment unless you're genuinely disciplined. Maximize Roth contributions first. Use SGOV for reserves instead of traditional bonds. A decade from now, you'll either celebrate taking action on these strategies or regret missing the setup while it was obvious. Your choice determines your outcome. Subscribe for data-driven answers backed by verified research. Like this if these strategies transformed your SCHD approach. This content is for educational purposes only and not financial advice. All investing carries risk. Past performance doesn't guarantee future results. Do your own due diligence and consult a qualified financial advisor before making investment decisions. This is SCHD. Welcome to wealth construction that survives when everything else collapses. Smash that like button, share this with someone who needs it, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.